Morning, everyone. On behalf of the ISO, we'd like to welcome you to today's extended daily market performance stakeholder meeting to discuss the May report, which was posted yesterday. I've inserted a link for that in the chat for finding the report and other meeting materials. My name is Christina Guimera, representing ISO Stakeholder Affairs, and I will be facilitating today's meeting. I'm joined by Guillermo Bautista Alderete, Abhishek Khandewale, Jenny Araj, Daniel Jing, Scott Lehman, and a few others there in the conference room as well. Just a few reminders here before we get started. Today's call is being recorded for informational and convenience purposes only. Any related transcription should not be reprinted without the ISO's permission. This meeting is intended to stimulate open dialogue and engage different perspectives. Please keep your comments professional and respectful today. Also, please try to keep your comments and questions succinct so that we're able to hear from everyone. You can access closed captioning on the bottom left hand of your screen, and the Inteller Transparency Viewer to view other callers on the call is available on the bottom right of your screen. Just be sure to refresh that prior to viewing. And we welcome and look forward to your engagement and participation today. Couple reminders for raising your hand during the meeting. The raise hand icon is on the bottom right of your WebEx screen. And if you joined audio only, please press *3 on your device to join the queue. Please remember to state your name and affiliation first before speaking. And please make sure to pause a few seconds before speaking after you unmute to avoid any WebEx delays that can cut off your introduction. And you can also send in your comments and questions via chat to all panelists. And if you need any technical assistance during the meeting, please send a chat to the event producer in Teller Events. So with that, I will turn things over to Guillermo Bautista Alderete to get us started.
Thank you, Christina. Good morning, everybody. Thank you for the opportunity this morning to discuss the performance of the extended day-ahead market. This is the first of the 6-month series that we're going to be reporting and discussing after the implementation of the extended day-ahead market. This is part of our commitment that we had prior to going live to ensure that we provide timely information about the performance of the market. And we have been doing this on a monthly basis. By the time we complete the pack, we are going to be already on board in Portland, and we will continue to do that assessment on a monthly basis. I would like to emphasize a couple of items before we go into the matter of the discussion, and that is we are trying to have a balancing act here in terms of, one, giving you all access to the information that we can provide, and more critically, in a timely fashion. Naturally, this is a very quick cycle that we are putting ourselves, because just in order to put information for May, we have to wait until the settlement cycle comes. That is basically by June 10th. So effectively, we have 1.5 weeks to put all this material together. And the depth and the extent of information that we can put together is going to be limited of how quickly we can put that in such a narrow window. We could do a more comprehensive assessment, include more analysis, more depth of the analysis, and come back with that report 3 months later or 6 months later. And obviously that wouldn't meet the mark of the expeditious discussion of the performance. That is the balancing act that we're trying to accomplish here, and I hope that you can understand that it's a quick turnaround that we're putting ourselves to provide that transparency, and it comes with a trade-off of how depth we can have in this type of discussions. The content of this report that we posted yesterday and that mirrors the information that we have summarized in this presentation is our first round of bringing together different metrics to try to give you the perspective overall how the extended day-ahead market is performing. This is not a static set of metrics. It's going to continue to evolve as we continue to assess the different functionalities of the implementation that we had. We expect to have additional areas of analysis. We expect to have deeper analysis of the existing metrics that we have as we evolve into the upcoming months. If you don't find an area or the depth enough in this first report, that may be expected. just because of how much we can do in this critical narrow window of time. If you have any suggestions or any item that you feel that is critical for us to analyze and provide information, please submit the comments that we are going to open up. They are going to be due on July 10th, so that we can have that in mind when we prepare the upcoming month report. As I indicated, it's an evolving process, and that includes the type of analysis, the depth of analysis that we are embarking in this effort. The other piece that is very critical to put in context is that we are reporting today the first month of operation, that is effectively the calendar month of May. And generally speaking, you are going to see that the market outcomes were expected. They are within typical economic ranges. We consider this to be a robust market outcome that we have seen for the first month. And not surprisingly, it aligns with the expected outcome that we could see for this time of the year. The emphasis I want to put on this is that this is the first month of operations. This is first the critical month where we have transitioned into this new functionality. Naturally, there are going to be challenges that we have to take on. That includes also the natural evolution and maturing of the participation of market participants in the extended day ahead market. They are adapting their processes. They are learning more about how to participate with the new market products. And it is a learning curve that everybody is going through this new market design that we have put in place. We have come across different issues identified either on the market upstream in the actual market solution, or in some cases in the settlement process. We are addressing those as we find them, and we are trying to provide also the transparency of these issues, and they are reported in this first session. That is the last section that you can find in the monthly report. And we will continue to have these calls. The next one that is scheduled for the end of July, I believe is now for July 30th. That basically overlaps with the market performance and forum meeting. We're going to hijack the MPPF to continue the discussion of the extended day ahead market. And in that case, we're going to be reporting the first 2 months, May and June. Next slide, please. When it comes to the market as a whole, there are many different areas that I hope that you can appreciate now when you look at the detailed report. And there are practical items that we care about because it has implications how it's going to be able to support different functionalities in the market. And one of those has to do with how many constraints eventually we can enforce for imbalance reserves. That is a discussion we have during the parallel operations effort for the configurable parameters. And the first topic here is how fast we can run the day ahead market. Our normal process is to go from 10 a.m. to 1 p.m. In summary, we were able to publish results of the day ahead market in 61% of the days. Effectively, that is 19 days out of 31 in the month of May. That is a lower rate in comparison to the month of April prior to the implementation of the EDAM. And that's somehow expected because we were deliberate to take additional time, at least very explicitly in the first half of May, to ensure that we double check all the setup, all the inputs, that we further validate the market results, and that naturally takes more time. As we progress and we get the market stable and settled in all the processes, we expect to come back to the business as usual in terms of running the day ahead market. When it comes to the resource efficiency evaluation, given the time of the year, given the setup that we have in the extended day ahead market, it's not surprising that we have effectively a very high passing rate of the resource efficiency evaluation. Overall, it is over 99% of the time for the month of May. When it comes to prices, this is, I would say, the most basic preliminary information you can get a sense of how the market is performing when we look at the prices. We have the energy prices that are the key prices in the market, And when you see the discussion later on, you are going to find that they remain quite moderate, not surprisingly aligning with the expectation of this time of the year. May happens to be a shoulder month when we are evolving from spring conditions to summer conditions. We have plenty of renewable generation, moderate level of demand, and prices tend to track that pattern for the seasonality. We also have new market products introduced, such as imbalance reserves and reliability capacity. And when we see the procurement, the prices, and how they are moving across the wider footprint, we are seeing that they are performing as expected. They have been procured largely based on economic basis, and the prices are reflecting the nature, the pattern of the requirement that we have in place. Next slide, please. One of the key elements of the extended day-ahead market is the ability to have economic displacement among the different balancing areas. And that is enabled by the transfer capability in connecting different balancing areas. We are very happy to report that the extended day-ahead market has been leveraging quite a lot the transfers to economically supply the demand in the different balancing areas, not only for energy, but also for reliability capacity and also for imbalance reserves. And it has happened in both directions, imports, exports, into, out of the different balancing areas. There is another area that is quite of interesting topic that we are going to be covering in these sessions, and that has to do with the congestion. This is specifically the topic related to the congestion revenue allocation. We have been tracking how that process has been working, and we have some numbers to report. Overall, we see that the dollars related to the congestion revenue allocation are relatively low in comparison to the total congestion cost observed in the extended day-ahead market. One of the best ways to summarize the total effect of the changes is by looking through the lens of the overall wholesale cost. This is a metric that we consistently track, and this wholesale cost accounts for basically all the costs that are eventually paid by demand. That includes the energy cost, ancillary services cost in both day ahead, real time, the uplift like bid cost recovery, the congestion and energy offset, even the GMC. And when we try to compare that metric in comparison to April prior to the EDAM, we can see that the overall average cost is in the range of $19 per megawatt, pretty comparable to the value that we observed in the previous months and relative to the same time of the year in 2025. Lastly, we're going to cover some list of market issues that we have identified through the validation and assessment of the extended day-ahead market performance. Some of those have been already discussed in previous calls, such as in the 4 calls that we held back in May about the implementation and the market updates. Some of those other issues have already been discussed in the settlements user group calls as early as last week. So this is a longer list of all these items that we have previously discussed and some new ones that are more recently discovered. That list, however, is not a comprehensive, exhaustive list of every single item that we may have in tracks, mainly in the area of settlements. I want to put that caveat because it's the list that naturally comes at the intersection of the EDAM performance that we look upstream and that in some cases realize downstream. Next slide, please. With that, let's go a little bit deeper into the different components of the report. And it is important to put some context of what we are reporting here. We all know that we went live with what typically we refer only as the EDAM market. This is the extended day-ahead market that effectively extends the design, the day-ahead market, to other balancing areas beyond the CAISO balancing area. However, at the same time, concurrent with that implementation of the EDAM, we actually implemented a suite of market design enhancements. that we have called the day-ahead market enhancement. It is this suite of enhancements that brings the new market products such as reliability capacity and imbalance reserve. And it is also includes the new formulation of the greenhouse gas emissions applicable to the day-ahead market. We already have a formulation, a modeling of GHG for the real-time market, and now we have expanded that to the day-ahead market. Therefore, we have allocation of GHG and we have pricing for GHG as part of the day-ahead market. One of the key features of all this implementation is no doubt the introduction of the imbalance reserve product. This is directional, it can be upward and downward, and this is precisely to provide a market mechanism to secure the flexibility that is needed when we go from the day ahead to the real time and uncertainty realizes. The uncertainty that we specifically track is related to the changes of load, wind, and solar production. This complements the market product that we have for the real time, that is the flexible ramping product. This is a market solution for an operational need that has been in place for many years. That operational need has become more evident as we have larger penetration of renewable resources and the uncertainty becomes larger. And having these market products effectively allow us to price explicitly the value for that flexibility through the market and procure that need effectively through economical signals. That is the intent of having moved to a market product to provide that uncertainty need. Next slide, please. Okay, with that, let me go now into item by item. And this is a high-level discussion of what you're going to find in the report. The report has many other metrics that we are not putting in this presentation today, but you can analyze on your leisure time. And I would like to emphasize a few items as we go through the presentation. And one of those is how well can we run the day-ahead market now that we have this more complex, larger optimization problem to solve. You are all very aware of the standard processes that are composing the day-ahead market. We have the market power mitigation, the financial market, that is the integrated forward market, and we have the residual unit commitment, the ROC process. In addition to these existing processes, as part of the EDAM team, we have introduced new processes. Now we also have an optimization to get a benchmark baseline for greenhouse gas emission. That comes before actually starting running market power mitigation. Then with the introduction of reliability capacity as a product in which participants can bid in, we have introduced now another path that is market power mitigation for the ROC process, where we assess potential structural conditions for market power mitigation related to procuring reliability capacity. That is, again, a new process that is introduced in the market and is a whole optimization problem that has to be solved. So we have basically doubled the number of processes that now we have as part of the day ahead run every day. On the other side, we also have now a wider market footprint. We have the 3 balancing areas, and that is going to continue to grow. And that effectively means we have a larger model to solve. And in addition to that, we also have new market products that come with additional constraints. So effectively, we have a more complex and larger optimization problem to solve. That, together with additional processes, naturally is going to put pressure in the runtime that we have to complete the day-ahead market by 1 p.m. The trend that you have here is comparing the running time and the publication time in April, just the month prior going live with EDAM, with the running times and the publication time of May. And anytime there is a bar higher than the horizontal line at 180 minutes or 1 p.m. publication time, it means it is a day where we publish the results after 1 p.m. And overall, we have been able to publish the results in 19 days out of 31 before 1 p.m. As we continue to settle the market, the processes are tuned, and we have everything business as usual. We expect that this trend can be improved. Next slide, please. Another new process that I actually forgot to mention in the previous discussion is the introduction of a resource efficiency evaluation test, very similar to the test that we have for the real-time market. Prior to participating in the market, each balancing area is subject to this resource efficiency evaluation. Effectively, area by area, we are assessing if there is enough capacity, enough supply to be able to meet each area obligation. We do that directionally in the upward and in the downward direction. For the requirements of the resource efficiency evaluation, effectively what we have is the energy need, meeting the demand, plus the flexibility need, meeting the imbalance reserve requirements, either up or down. This can be graphically observed in this illustration that is organized by balancing area. We have the dark blue line that stands for the energy profile, the demand that is subject to assessment for that day. And then you have this envelope above and below the demand obligation that encapsulates the need for flexibility that is captured through the imbalance reserve requirement. That is the bandwidth, the envelope that is created by providing not only supply to meet the energy needs, but also the flexibility need. That is the tolerance where we have to operate. When we look at the overall performance of the resource efficiency evaluation, both Pacific Corporation East and the CAISO balancing area passed 100% all hours for the month of May in both the upward and downward direction. And that basically means a passing rate of 100%. For Pacific Corporation West, there was one day, May 7, I recall, where we have 7 hours with upward failures and 1 hour of downward failure. Altogether, that gives a passing rate of 99.4% for the month of May for this balancing area. And this is very good results, expecting to have such a high passing rate is just a evidence of how well each balancing area is bringing the capacity, the supply needed to meet its own obligations. Once we go into the market, all that capacity is going to be economically assessed to find any potential economic displacement. And this is really the power, the efficiency of having this extended day-ahead market, because now with the transfers available and having supply enough in each balancing area, it is up to the market to decide how to meet the demand need at the least cost, leveraging the diversity of supply across the extended day-ahead market footprint. Next slide, please. This is a summary of key market products just to put in perspective how they align one relative to the others. This is organized by market product. On the far left, we have energy prices. On the far right, we have the greenhouse gas prices. That is actually a component of the energy prices. And in between, we have the imbalance reserve prices and also the reliability prices. These are organized by balancing area, and it is also reflective of only the prices for the month of May. In some cases, such as imbalance reserve and reliability capacity, we have potentially products that could go in the upward or in the downward direction. And that is actually more specific for imbalance reserves. So overall, you are going to see another feature through this comparison. The first one is the relative magnitude of one product versus the other. Yes, it is expected that we're going to see prices for energy to be the highest. This is the actual energy that is produced to meet the demand. Imbalance reserves, reliability capacity, and even greenhouse gas prices are a reflection of services that are companion to meeting the load obligation. And we expect those prices to be relatively lower to the energy prices. And that's the case in here. Across the different balancing areas, we see that the imbalance reserve prices tend to be lower in comparison to the energy prices. Similarly, reliability capacity, that is to fill in the gap between what is procured in the financial market versus the need to meet the load forecast, is also coming lower, but relatively higher than imbalance reserves. The other feature that you can see here is that there is naturally price separation among the different balancing areas. We do see different prices for each balancing area overall for the month, and that is no more than the reflection of the economics of the wider footprint. Now, price separation on its own is not a negative connotation of how the market is performing. It's actually a reflection of how the energy is priced in the system. And that price separation is going to originate anytime we effectively exhaust all the transfer capability available. And that is when that price separation effectively isolates each balancing area to its own local economics. If there were infinite amount of transfers such that power can freely move in the wider footprint, effectively we would see one single price. Here is a signal that indeed the market has been able to maximize the economic displacements among the different balancing areas to the point that it has created this price separation that reflects the local economics of each balancing area. When it comes to imbalance reserves, we also see price separation across the different balancing areas because it's not different in terms of the construct that we have for energy. And you can see also that there is indeed differences between the directions of the imbalance reserve. We tend to see higher prices for upward imbalance reserves in comparison to downward reserves. And that is somehow expected because it's more difficult to procure for upward capacity than downward. When it comes to reliability capacity, we do also see price separation across the different balancing areas, and prices tend to be maybe in the range of $5 to $3 on average. The last piece, that is the GHG. This is not a price on its own, it's simply a component that make it up into the full LMP of the energy price. And here the relevance is that we have introduced the formulation of the GHG in the extended day-ahead market, similar to the formulation that we have for the real-time market. And now it is an explicit price component of the prices in the day-ahead market. Next slide, please. We can go a little bit deeper and go product by product. Now, this is the information regarding the energy prices. In some cases, you are going to see a comparison relative to the previous month when that comparison is available. In this case, we have a comparison of the energy prices, and these are for the CAISO balancing area, effectively the weighted average prices of the DLABs in the day-ahead market. We do have prices for the CAISO balancing area in April, but we don't have those for PAC because we just launched that starting May 1st. So naturally, there will not be prices for PAC in April. Then we can compare the trend of prices between April and May for the California balancing area. The shape is not surprising for this time of the year. Again, this is the shoulder month when we have plenty of renewable production in the middle of the day, and naturally that is going to depress prices in midday hours. That happens in April. That pattern continues to some extent in May and starts to fade away as we go into the summer. And then the ramping periods are going to put upward pressure on the prices for both the morning and the evening. And that's the reason you can see these higher prices in hour ending 7, hour ending 8, and also in hour ending 18, 19. That is just effectively a reflection of what we typically refer as the duck curve. The prices are following the trend of supply availability. When we overimpose the prices for the new balancing areas in the market, PAC East and PAC West, the general pattern follows the same trend. They have similar trajectory of prices spiking in the morning, getting depressed in the middle of the day. The level of prices vary from area to area. In general, for the month of May, we tend to see that PAC East prices were lower and PAC West prices were higher. CAISO fell in between. And that again is reflecting price separation across the different balancing areas of the market, which is a reflection that the market is at some point exhausting all the transfer capability available to maximize the economic displacement of moving a cheaper supply to meet demand in more expensive areas. That is indeed an expected efficiency of having the market to find out these economic opportunities. Next slide, please. This is a different way to see the prices when we put in perspective now the real-time price. Even though the real-time market didn't have many specific changes in terms of market design, there is expected some implications of how the performing of the day-ahead market may play out when it comes to the realization of the real-time performance. And a simple way to start appreciating that is comparing the prices. And we have consistently tracked the price convergence across the markets, day ahead versus 15-minute market versus 5-minute market. We have two sets of metrics, one for each month, April as a reference for the before the EDAM, and May under EDAM. We have also that organized by balancing area, putting them together for each of the months. And then the different bars stand for the different markets, IFM, day ahead, and the real-time market for the 15 and the 5-minute passes. For CAISO, we tend to see kind of very similar price convergence that we see in previous months. And in the report, you can actually see a longer trend that goes over the last 2 years. For PAC West and PAC East, we can see that there is less convergence for the first month of May, and that's not surprising. As you may see in many other metrics that we have in the report, it is a transitional period where we are starting to see the implications of that first days of operation. A lot of volatility that was experienced in the month of May actually is concentrated in the first half of the month. As you can see, as we progress towards the end of the month, prices and the overall performance of the market settle down better. There are some natural price separations across the market for PAC East and PAC West, and that in some part has to do with the structure that we have in terms of the EDAM versus the EIM. EDAM has the ability to move power up to the point of transfer capability available, which is way more limited than what is readily available in the real-time market. Effectively, in the day-ahead market, we have transfer capabilities only among 3 balancing areas, while in the real-time market, that transfer capability grows quite a big difference because we have more than 20 balancing areas. So that naturally sets different conditions of supply, demand, and how the economic displacement can happen. And that can actually help to handle tighter or long conditions of supply in each of the balancing areas. Next slide, please. One area that we also consistently track is how the CAISO, through an organized and centralized market, track relative to another reference that is available in the West. And that other reference is the prices coming from bilateral external prices. In this case, we use as a reference the prices from the ICE system. And we have some specific hubs that we use as a reference. We use the Mid-Sea as a reference for the Pacific Northwest. We also use the Palo Verde as a hub reference for the Desert Southwest. And then the different bars that we have at the top is for the different balancing areas that are comprising the extended day-ahead market. As you may hear many times through the presentation and also in the report, 1 month is not enough, long enough trend to make conclusions of convergence. It's just too short of a period. we expect to see better trends as we collect more operational data over the month. But just looking in isolation for the month of May, we can see that historically, the bilateral prices tend to track close to the CAISO prices. In general, the bilateral prices tend to be higher than the CAISO prices. For the month of May, there was quite a divergence between all these prices because prices in CAISO, either CAISO balancing area or PAC East or PAC West, were in a different place, as illustrated in the previous slide, and the bilateral prices somehow track closer to CAISO prices. When it comes to the volumes, we don't appreciate a significant change in the activity as measured by the volume traded for the bilateral prices. And again, we will continue to track this over the months just to see if over the longer term, we can appreciate any impact or convergence in relative to the external transactions that happen through bilateral prices. Next slide, please. Okay, I think we have covered some good portion of material so far. Before we keep going, Christina, I think this is a good time to pause and see if we have any follow-ups or any questions that we can entertain now.
Taking a look to see if there's any hands raised. Just a reminder, folks, that the raise hand icon is on the bottom of the screen, and if you're having trouble doing that, you can also send a chat question in as well. I'm not seeing any questions coming in at this time, Guillermo.
Okay, I will pause for a bit, and Dan is going to take care of this next topic.
So Guillermo, we did just receive a question in the chat. If you'd like to take it now.
Let me see if I can look at the question, Christina.
Yes, I'll send it to you.
Yeah, no, yeah. Okay, can you please? Can you please talk about the pricing impact of how PAC East and PAC West must be at or below the CAISO approved default energy bid? How at or below the CAISO approved default energy bid? I'm not so sure to understand what the question is. I can see a couple of items that are relevant to the information that we have been discussing about the EDAM. We understand that the participation of both PAC East and PAC West is subject to the market rate-based authority issue prior to go live, in which resources belonging to PAC corporations have to be bidding at no higher than the default energy bid. While other third parties don't have that restriction, including resources in the CAISO balancing area. Effectively, that means that we could expect to see that bids for energy in the Pacific incorporation areas are going to be potentially lower than otherwise we could see once there is no such restriction. And that in turn is going to reflect on the prices for not only PAC areas, but also in the CAISO, because again, as long as there is transfer capability available, these economics are going to play, right? If there are cheaper resources, regardless where they are located, regardless of why they look to be cheaper in the CAISO market, they are going to be dispatched first in order to meet the demand across the wider footprint. Okay, let's move on.
We do also have a couple hands raised before moving on, Guillermo.
Okay, please bring those.
First, we have a hand raised by Jordan Minor.
Hi, Jordan Minor, CPUC Energy Division. First, good morning, and thank you for all this analysis from your team. Just an easy, quick question here. Where do we stand on the GHG constraint that we turned off pre-go live? I remember Khalid gave an update on it right before go live, and it would be communicated further with stakeholders to the extent it was turned back on. So just an update on that would be nice. Thank you.
Sure. Yeah, I can just verbally update on that. Effectively, there is no change since day one of the go live. We are still doing internal assessment of what potentially we could do. You would expect that when we are ready to have the discussion, we are going to have a public discussion to go over that. But at this point, whatever was in place on May 1st continues to be in place as of now.
Thank you.
Thank you. And we have one more hand raised by Steve Keen. Go ahead, Steve.
Hi, Steve Keen from Edison. If we could go back to slide 10. I just have that's the one showing the price convergence. Have you looked in, and is the price convergence, the better price convergence in the CAISO as compared to the other two due to the virtual bidding in the CAISO? Is there any way you can check on that?
Yeah, that's a very interesting hypothesis, Steve. And I have to say there are many moving pieces. There is another element that we also discussed in the report, and there are, I would say, three main components at play. To what extent each of the components play a role in this is something that is the difficult part to assess. One component is that the CAISO balancing area has participation of convergence bids, supply or demand, and for the sake of the naming, that was precisely on point to ensure that it makes the reference of how it is expected that the virtual bids are going to help to converge the market. That is something that is only applicable to the CAISO balancing area now. The second element that can come at play, and we also report that in the actual report, is the potential participation, the economic participation of bidding demand. We historically have seen some differences between what is bidding and what is actually clear for bidding demand relative to the load forecast. That can also play a role in this price convergence. And the last one is also the transfer capability that I was mentioning earlier, right? When you have different setups between the EDAM and the real time, where the level of transfer capability for economic displacement between balancing areas in EDAM is limited, and you compare that to the wider, more expansive capability that we have in the real time, naturally you can also have different conditions. So to what extent convergence bids can be playing a role to help converge closer the day-ahead market? That's, I understand the question. I don't have a simple answer or a number to tell you how much of a good job is performing. And this is actually one of the metrics that we have tracked for this first month, and we will continue to report to see if over time we can unpack more of what is the effect of convergence bids after we have implemented the EDAM. So that is still an evolving discussion we're going to have.
Okay, thank you very much.
Thank you, Guillermo. And we have one more question in the chat before we move on. I inserted it to you, but I can also read it aloud. It's from Hui Yuan at SCE asking, could CAISO provide insights into the increase in ISM, SMN, and RTD LMPs from April to May across CAISO, PAC West, and PAC East?
Yes, and that is a very complex, it's a very straight question to have. It's a very complex answer to put. But I appreciate very much being asked this because it's important to put this in context. One of the key elements when we try to make any comparison relative to another reference is to ensure that we are making that comparison apples to apples. Naturally, even if you look at for, let's say, the year 2025, and you just compare month to month, you are going to see change. So prices in April of 2025 relative to prices in May 2025 are going to be different, right? Because it happens to be one of these inflection points in the operation of the system. We are coming from a spring conditions where we have very low levels of demand. We have plenty of supply from renewable resources just making their way to meet the supply. And then you start evolving that trend right there in May, when we start having higher demand, the shape of the demand starts to switch from this valley in the middle of the day to a sustained ramp through the rest of the day. And then you have additional resources integrated. For instance, one of the interesting metrics that you can see in the MPPF is that we report the record of renewable production that we have in the system. And you can guess when that record comes at play. Well, it happens to come precisely in the month of May, in the month of June, because that is when we have the new resources and we have full production of renewable resources. So the point I'm trying to make here is that even without accounting for the implications of EDAM, it is expected to see changes in that critical period of March, April, May, when you are going and turning around, going from the low prices to the high prices. May already starts to be the month when we start going into the higher end of the price ranges. So because of changes of demand, because of changes of the mix supply, and so on, I want to emphasize that alone is going to create different price perspective when comparing April to May. Now, I could elaborate further and trying to unpack what are the implications by having the EDAM market in place. We expect to see some implications. That is expected because now we have a different market design. How that is going to play out when it comes to prices. If we were to set everything fixed, that basically means we can isolate all the moving pieces between April and May and just make them constant and the same. The effect that the EDAM could bring to the overall dynamics is going to be as follows. Effectively, we can assume that we have the same generation mix, the same supply available in the system. Now, with EDAM, we have to procure for an additional product that prior to May was not in place in the market. We procure that capacity through other mechanisms, such as adjusting the load in the ROC process, but that was not explicitly priced in the financial markets. So here you have April, same supply, meeting the needs for energy and ancillary services. You come in May, you have the same supply, the same needs to meet energy and ancillary services, plus imbalance reserves. Now you have to optimize in the day-ahead market how to optimally allocate the same supply that you have across the different products, energy, AES, and imbalance reserves. If you have another product that is explicitly asking for, I don't know, up to 3,000 megawatts of additional supply for flexibility, that naturally is going to put upward pressure in the energy prices. To what extent is going to be hard to isolate just because of all the other moving pieces. That is, in general, the conceptual expectation of how that could impact the energy prices. Long answer, but I really want to emphasize the importance to set a reference when we compare before and after, because it's not just the introduction of the market that is creating differences, it's also all the inherent differences that exist even without the consideration of the EDAM feature.
Thank you, Guillermo. And I'm not seeing any other questions coming in the chat or any other raised hands, so I think we can continue on.
Okay, great. Thank you, Christina. So before we move on to ancillary services and other products, we'd like to round out the review of the energy commodity by discussing changes under the EDAM for the locational marginal price formulations for the energy commodity. And we want to focus specifically on two of the LMP components, the marginal energy cost, or the MEC, and the marginal congestion cost, or the MCC. So prior to May 1st, in the WIM real-time markets, as you may know, there were two types of power balance constraints that were enforced. One was system-wide, defined across the entire WIM footprint for all WIM VAAs. And that system-wide power balance constraint, or PBC, was associated with a shadow price lambda here, and we called that the SMEC, the system marginal energy cost. On the other hand, we defined a second type of power balance constraint that was BAA specific, unique to each BAA for each and every single WIM BAA in the WIM except HISO. And we associated the shadow price of this BAA specific PVC with the notation lambda J, where J denotes BAAJ. So we had two types of power balance constraints that are enforced in WIM. Lambda, or the SMEC, the system marginal energy cost, that used to set the marginal energy cost component for all WIM BAAs and all nodes, so shared by everyone in the WIM, whereas lambda J, the shadow price of the BA specific PVC, was actually included in the marginal congestion cost, or the MCC. So the power balance constraint shadow price for each BAA was included in the MCC, along with congestion on transmission elements such as flow gates, nomograms, etc. So we have a breakdown of that here with a notation for a non-KISO EIM resource, where the SMEC is lambda. Again, that's the shadow price associated with the system-wide power balance constraint. And the marginal congestion cost was a function of multiple components. First and foremost, there's that BAA specific PVC shadow price, lambda J, as well as mu of n, which is the shadow price on any given flow gate or nomogram multiplied by the corresponding shift factor. So this was the MEC and the MCC formulation prior to EDAM launch on May 1st. Next slide, please. We can further decompose the MCC before May 1st. And it turns out that lambda J was actually itself consisted of multiple components, namely the shadow prices of the transfer constraints. So there were two transfer constraints that contributed to this lambda J. One was the EIM transfer distribution constraint. That's the first equation shown here. And this equation related the overall net EIM transfer of BAJ, which is denoted here as C sub J, and related that to the individual ETSR schedules for all the ETSRs export and import defined for that BAA. And so this so-called EIM transfer distribution constraint was associated with a shadow price phi J. And the next equation was the EIM transfer scheduling limit. This was a limit on the overall transfer for that BAAJ, subjected to lower and upper limits. And these inequalities were associated with the shadow prices, respectively, nu J and epsilon J. Xi J, excuse me. And the important point here is that lambda J, which is the BAA specific power balance constraint shadow price, was the sum of these two transfer constraint shadow prices. So this is how the MCC was decomposed prior to EDAM launch on May 1st. Next slide, please. Now, moving into EDAM, both the MEC and the MCC were reformulated as of May 1st in both the day-ahead and real-time. So day-ahead, obviously, now we have multiple BAAs other than the ISO, but across all the EDAM BAAs, there is no system-wide PVC. The same is true for the WIM. There's no longer a system-wide power balance constraint defined across the WIM footprint, and that means there's no more SMEC or lambda. So WIM BAAs no longer share a constant marginal energy cost across the entire market footprint. Now the MEC is BAA specific, And we're still denoting that with lambda J. And the lambda J still contains the same transfer constraint shadow prices that we discussed on the previous slide. Phi J denoting the shadow price of the transfer distribution constraints, and nu and xi here denoting the shadow prices on the EIM or EDAM transfer scheduling limit constraints. Now, the MCC then, given that the transfer constraint shadow prices were moved out of the MCC to the MEC, the MCC now only reflects the congestion on the transition elements like flow gates and nomograms. So here's a table kind of tabulating where all the components were before and after May 1st. So again, to summarize, before EDAM launch, the marginal energy cost component was the SMEC that was constant across the entire market footprint, and the MCC had the BAA specific transfer constraint shadow prices like Phi J and the other constraint shadow prices. But those have now been moved into the MEC now that there's no more SMEC. The MCC now only reflects congestion on flow gates and nomograms. Now, one of the reasons for driving this reformulation is to support some downstream settlement processes, such as transfer revenues, which are a function of the MEC delta between any two given BAAs. And so in order to support that, we needed to make sure that the BAA MECs were specific and unique to each BAA instead of having a uniform SMEC across the entire market footprint. Next slide, please. So just put some numbers on how this reformulation looks like in actual market practice is a comparison of April and May. So at a very high level, when we look at April and May in isolation, I think the takeaway, for these 2 months is that the LNP components for the energy commodity have been reshuffled, and the absolute value of the components that there's been relatively little change. Again, before EDAM in April here, the blue here represents the SMEC, and the blue here now represents the BAA specific MECs. You can see there's a significant impact on this particular piece of the LNP before and after EDAM launch. Now, one interesting thing to note is that the GHG component of the LNP used to be embedded in SMEC and for CAISO, and used to be subtracted out as a negative adder for non-CAISO BAA. So you see that negative gray component here in April below the 0 line here for PAC West and PAC East. This denotes a negative GHG component for those non-CAISO BAAs. Now, with the reformulation, there's no more SMEC, and given that the MEC is now calculated for each BAA, the GHG costs are now additive for the non-CAISO BAAs, and so you can see that the gray components are now here on the positive scale for PAC West and PAC East. Perhaps a little too small to see here. And for the congestion piece, which is indicated by the dark navy blue, there's a little bit of an increase in the real-time congestion component for the PAC BAAs from April to May, but that is more or less consistent with what we observed for these 2 months in prior years. Okay. Next slide, please. Thank you.
Thank you, Dan. Let's keep moving now with a different topic. This is just a summary of the newly introduced GHG formulation in the day-ahead market. We are basically reporting the most obvious metrics. One is the prices and the other one is the allocation. Prices, and you may have also seen that in previous slides, were relatively modest in the range of $3 to $4 for the month of May. There was more activity in terms of the transfers in the first half of the month, and that is going to be reflected in the allocation that we have in the first half of the month. And we will continue to report on these metrics. There could be some further details that we can provide in terms of who is getting that allocated, and that is an evolving set of metrics that we can put in the future reports. Next slide, please. There is another very interesting dynamic that we have observed once we have implemented the EDAM DIM. The way we set up the requirements for ancillary services, regulation up, down, spinning reserves, non-spinning reserves, has not changed with the EDAM. We continue to do the same way how to procure requirements. But what we have seen is how the implementation of EDAM has introduced a slightly different pattern, how we actually procure ancillary services. We have a feature in the market that is applicable for the upward ancillary services, meaning regulation up, spinning, and non-spinning. That feature is typically referred as cascading or rational buyer, and simply means that when you have the need to procure requirements for a specific service, like spinning reserves, you can meet that requirement with the bid and the supply available specifically for that service. Bids and supply for spinning reserves can be used to clear and procure for that service. But we can also allow higher quality service, such as regulation in this case, to help meet that requirement. So in that case, we can have regulation up procurement in excess of the regulation requirement, because that excess is going to be used to meet the requirements for lower services such as spin and non-spin. That is a very typical dynamic that we have seen in the system, given the fact that we have plenty of availability of supply for meeting regulation up requirements, to the point that now we can use that to meet partially the spinning reserve requirement. This is a busy metric on the top right that basically tells you the percentage of the requirement that is met with the specific ancillary service. 100% value means you are meeting 100% of that service with the bid supply from that service. If you have a value greater than 100, means you are procuring more or above the requirement of that specific service to serve other type of service. And what we typically have seen is that we clear additional regulation up to meet a spinning reserve requirement. What you are going to realize with this metric is that starting with the EDAM, effectively the rational buyer, the cascading of regulation up for a spinning reserve reduced significantly, in the range of going from almost 30% to about 5%. There continues to be a small cascading going from spin to non-spin, but the most significant change is applicable to the cascading of regulation capacity. This, again, is not because there is a change in the requirements of the AES, it's more about the economics to procure the different AES. And that had to do a lot with the following metric. Can we move to the next slide, please? When we look at the prices, we also look at the ancillary service prices for the CAISO area, which are the only ones that are currently optimized. We do see a small increase of prices, mainly for regulation up and regulation down after the implementation of the EDAM. And that increase has been large enough to create this interplay of the reduction of the cascading effect from regulation to spinning reserves. I want to emphasize that this simply means we are relying less on regulation up to meet the requirements for spinning, but we still fully procure the requirements for spinning. It happens to be now mainly from its own supply of a spinning reserve feed. The lower part of the plot makes a comparison of the AES prices before and after the EDAM. And for May, in the far right, we also include the imbalance reserve. Generally speaking, what you are going to see is that overall, the imbalance reserve prices fall between the prices of regulation and spinning. They are cheaper than regulation. They are higher than spin prices. We will see how this trend evolves over time once we have settled better the market and we have a longer view of the dynamics over the upcoming months. Next slide, please. There is another key element of the extended day-ahead market, and that is imbalance reserve. Unlike FRP, imbalance reserve is a full market product in which market participants actually bid in for providing that service. There is a price quantity bid that they can put in, expressing the willingness to procure that service at a given price. We are tracking the bidding activity of these new products. They are brand new. We are quite interested to see what is the value that is being put through the bids in the market. These metrics show up the bid composition organized by price for each of the balancing areas. Each color is basically a price range of the bid submitted for the imbalance reserve. There is a positive and a negative range indicating that they are for the upward or the downward provision of the service. And the prices are going to be based on many different factors, the evaluation of the service to be procured, and this captures, in essence, what is the value assigned to providing that service through the market. We can see that the composition of the prices for these bids are quite different depending on the balancing area that you are looking at. And there are prices all over the range for the balancing area in CAISO. PAC has a more compacted range of prices, very consolidated in the low range prices. And we will see how this trend continues over time as we continue to collect more information and as participants continue to adapt to the participation of the market. Overall, volume-wise, we see a very steady volume of participation for imbalance reserves. And I see a hand, Christina, maybe we can take it now.
Yes, we have a hand raised by Alva Svoboda. If we could please unmute Alva. Alva, it's showing that you have no audio on our end. Maybe try connecting with a different mic or send in your question via chat. We're not able to hear you. Can we try unmuting Alva one more time?
I think I'm good now.
There we go. We can hear you now.
Just my question was on whether these are residual to the energy awards when you're looking at the volumes, because it looks the zero volumes are smaller than I would have expected on the imbalance reserves.
Yeah, this is a very good question, Alba, and I appreciate that because it provides color into what these metrics really mean. These are the bids as it is submitted. And this is somehow an overly optimistic view of how much capacity is actually for imbalance reserves, because this is submitted obviously before the market is run, right? So much of this capacity may be overlapping with capacity that is going to be available for energy, but we don't know that by the time we are going to clear the market. So this only tells you capacity-wise, this is the bid that were submitted. Much of that capacity is going to be potentially procured for energy or for other services. And we're trying to see if we can improve this metric to try to give a more descriptive measure of what is effectively available for imbalance reserve after the optimization.
Right. Okay. And just if we were trying to check on these numbers, we could go through the EDAM daily reports and essentially see the component that is making this summary up for the. This is basically, it looks like it's by day, right?
Yes, this is a daily average. And
yeah,
you're right. Once you go into averages, you lose some visibility of the dynamics.
Okay, great. Well, we'll take a look at that. It's just a little surprising that the amount that's bid at zero is so small here. So thank you.
Yeah. Okay, next slide, please. Now we move into how we have procured for imbalance reserves. Here we have two key metrics. One is the procurement of imbalance reserves, and we are just putting a sample for PAC West and CAISO. We have the equivalent metric for PAC East in the report. It's just a matter of spacing here. And on the left-hand side, we have the comparison of imbalance reserve prices. When it comes to the requirements, we have the positive, upward, the negative, downward requirements. And you can see that it follows a very well-defined pattern. For the CAISO balancing area, we tend to see very low levels of requirements in off-peak hours, first hours of the day, very last hours of the day. We have the highest requirements around the morning and the evening peak. For the CAISO area, the max is around 3,500 megawatts in the upward direction and about 5,000 megawatts in the downward direction. And then you have this valley in the middle of the day. That is a very consistent trend of the requirements that we have in place for the CAISO. For Pacific West, there is to some extent some pattern in the requirements. Similarly to CAISO, they tend to be highest for the morning and the evening peak. The values in the other hours tend to be more significant in comparison to the proportion that we have for the CAISO. And when you come and see the prices are going to naturally follow the pattern of the requirements. We can see that regardless of the magnitude, the three balancing area prices tend to follow very similar profile. And that's expected because in the end of the day, we are clearing all three areas together. And in addition to energy, we are able to have economic transfers also for imbalance reserves. What is happening with all this is that we see prices for imbalance reserves to go the highest in both the morning and the evening peaks, with very low prices for the rest of the hours. And that mimics to some extent the profile of the requirement that we have on the right-hand side. The other element is that you will continue to see price separation across the three balancing areas. When you look at the other metrics that we have in the report, you are going to appreciate that there was more volatility in the first half of the month, and that is going to be reflected here because these are the monthly averages. Prices for the different balancing areas converge to different values depending on the area that you are looking at. Next slide, please. There is a difference, even though the pattern may be similar, the magnitude of the prices between the upward and the downward direction are quite different. The value for imbalance reserve up tend to be higher than the price for the imbalance reserves down. And that holds true for the three balancing areas. On the left-hand side, we have the daily trend, and this really allows you to appreciate how the prices have gotten more stable as we move towards the end of the month. The first 2 weeks is when we have a lot of volatility, and again, that is expected. That was the most critical time of the transition into the extended day ahead market. Next slide, please. The other area that we are looking at is how we are able to procure the expected requirements for imbalance reserves. The big question is who is providing that service in the different generation mix components that we have. We have this breakdown by each balancing area, but here we are just portraying one that is the CAISO balancing area. And you can see through the hourly profile of the day, on average, what technologies are supporting the provision of imbalance reserves, both upward and downward. For the upward, we have a very consistent trend of gas providing some reasonable amount of flexibility throughout the day, in all 24 hours. That increases mostly in the morning and evening peak. Then for the middle of the day, when we have the available supply from solar resources, we can see that solar provides quite a meaningful share of imbalance reserves, both up and down, for specifically that period, middle of the day. And then the interesting part here is the provision of imbalance reserves up or down coming from storage resources. Storage resources, unlike what we saw in parallel operations, have relatively a small contribution to the procurement of imbalance reserves, and that is mainly concentrated in the peak hours. You can see that dark blue in the peak hours of hour ending 8 and hour ending 19. That is where storage resources are providing flexibility to the system. When we go into the other balancing areas, such as Pack East, the mix is different because the generation mix is different. So for Pack East area, the main contributors for supporting the imbalance reserves are coming from both coal, but also from imports from the other balancing areas. And when it comes to Pack West, the main technology supporting imbalance reserves is hydro, complemented with transfers. We will continue to see over time how that generation mix supporting the imbalance reserves converges. And this is just a very interesting piece to see because there was a lot of concern during parallel operation discussions when we were approaching the configurable parameters of how the setup of the system could lead to have certain technologies supporting more or less imbalance reserves specific to storage resources. As of the month of May, storage resource has not been largely utilized to support imbalance reserves. Next slide, please. Moving on to reliability capacity, we have the same breakdown. This is reliability capacity, and is for the upward and downward direction organized by price. We see a very steady volume of capacity in terms of bids submitted for supporting reliability capacity. Same discussion as we have for imbalance reserves. This is just the upfront as is bidding capacity available in the market. Much of this capacity is going to be eventually utilized for energy or other services, so it's not exclusive of just providing reliability capacity. Next slide, please. Convergence bid. This is another factor that came to the discussion earlier today. In short, we don't see any significant change of patterns in the participation of convergence bids. Yes, if you compare a previous year versus this year, you are going to see effectively the same patterns. When you compare April versus May, we can see a small variation. The pattern continues to be largely the same. Potentially, there would be a smaller net supply for the month of May, but overall, the profile continues to be quite consistent. This is another area that it really takes a longer period of time to assess any potential evolution of the participation in the market. Next slide, please. When it comes to how we are procuring for reliability capacity, the picture is quite different depending on which balancing area you are looking at. In general, we tend to see that across the different balancing areas, the need is to procure for reliability capacity up. That is in general the trend. For the CAISO, we have indeed seen some interesting profile because in addition to the directionally upward capacity provision, we have seen instances where we are procuring reliability capacity down. When it comes to the profile, I think it's quite varied because unlike imbalance reserve that is explicitly defined ex ante, the requirement for reliability capacity is dynamically assessed based on what the actual IFM solution is. Because reliability capacity is going to be there to fill in the gap between what we clear for physical supply in IFM, accounting for bidding demand, accounting for participation of convergence bids, and what needs to be met for the load forecast in the ROC process. So it's a very dynamic process because it's indeed subject or depending to some extent on what the solution of the integrated forward market is. And similar to energy and imbalance reserves, reliability capacity can also be procured through the transfers. That means there can be transfers from one balancing area into another balancing area to meet the requirement. And Christina, we lost the presentation.
Yes, I'll get that loaded back up.
If you want to take control now.
I think we lost the audio from Christina as well. She may have lost the connection. Operator, can you move the slides?
Yeah, could you please move the slides? I'm having trouble on my end.
Sure. You know which number we left off on?
It's 21. Let's see.
Can you go somewhere halfway? I think we were in the 20 plus. Right there, yeah. Next slide, please. And one more. When it comes to prices, we see very similar trend. There is price separation for liability capacity across the different balancing areas. We saw prices coming more stable towards the second half of the month. And in some cases, you are going to see when you look at the report for the hourly profile, prices tend to be most of the time in the very low range. When we get into tighter conditions, prices tend to go quite fast to the range of $55. And that has some logical expectation because when there are resources that do not bid for reliability capacity and they have an RA obligation, as part of the process, we insert a $55 bid. Also, if there is market power mitigation being triggered and there is mitigation, that mitigation is going to be based on the default price that we have as part of the configurable parameters, and that price happens to be also $55. So $55 has some logical reference why prices may clear when it's tighter in that range. Next slide, please. The other area that is quite critical, but becomes less intuitive to appreciate the dimension that it brings to the extended day ahead market is the transfers. We have transfers capability available across the different balancing areas, between Pac East to Pac West, from Pac West to CAISO, from Pac East to CAISO, and vice versa. And the transfers are the ultimate reflection of the economics of the market. They're going to be very dynamic because they can change hour by hour based on the conditions of each given hour and reflect at the end the total economics of the wider market footprint. Transfers can be directional. It can be an import or an export for any given balancing area. And in some cases, we have seen that consistently, the transfers are fully utilized, meaning they are going to reach the limitation that is available in the market, and they are going to create price separation. We do see energy transfers across all three balancing areas in both directions. There may be, in some cases, a more defined pattern through the day when we are relying on imports or exports. That information is in more detail described in the report. I will just skip to the next one that is for the transfer related to imbalance reserves, please. This is a less defined profile and is also organized by balancing area. This is transfers that are deemed to be economic to support imbalance reserves. We do see transfers in somehow going in certain way at certain times of the day, and it's expected. For instance, you can see for the CAISO. For the CAISO, we tend to have more exports through the day, but in the peak hours, hour ending 8, 9 in the morning and 18, 19 in the evening, we tend to import that capacity. And you have also similar mirror profiles for Pac West and Pac East. Next one, please. Reliability capacity is also very dynamic, again, because it's predicated on what the solution of the financial market is. It's going to be less defined than the procurement for energy and imbalance reserves. But we still see that the transfers are being leveraged to move reliability capacity across the different balancing areas of the market, in both and the import and the export direction for each balancing area. Next slide, please. Let me pause to see if we have any questions before we take on the next two topics. Cristina, operator.
We do have a hand raised from Mike. Go ahead.
Hi, Guillermo. This is Mike McGuffin from CES. I was wondering if you could talk a little bit about the software defect that prevented energy storage from clearing for RCD and how that may have impacted the price spikes to 250 plus in early June.
Mike, sorry, I couldn't catch fully the question. Would you mind to please repeat it?
Yeah, I threw it in the chat too. Sorry, I've got a new laptop, so I may the mic may not be working. My question was, can you talk a little bit about the software defect that prevented energy storage from selling RCD and how that potentially impacted pricing, the price spikes that we saw in early June?
Okay, yeah. Would you mind to hold off that question when we reach the section of the market issues? We have that item explicitly listed there to discuss.
Okay, perfect. Thanks.
Thank you.
Thank you. We also have a hand raised from Steve Keen.
Hi, Steve Keen from Edison. I'm just wondering, can you show what the transfer capacities were? What these charts are showing is the actual transfers, correct?
Yes, they're optimized transfers in the market. We will consider that for future reports. Steve, right now we don't include that in the main report. It's part of the evolution of the suite of metrics that we have.
Okay, thank you.
I'm not seeing any other hands raised at this time.
Okay, thank you.
Okay, great. My name is Scott Lehman. I'm also in the Market Performance and Advanced Analytics group. And I'll talk briefly about the EDAM net export constraint and the RUC adjustments. So starting with the EDAM net export constraint, this is an optional tool for BAAs. And before the market runs, a BAA can elect to enforce this EDAM net export constraint. And if they do, then their net TSR exports will be limited to their excess RSC eligible capacity. And then they have the ability to kind of further tune if they want to reduce the total amount of eligible capacity that they have to export on their EDAM transfers. They can do that using the reliability margin. Or if they want to make the constraint less stringent, they can also use the confidence factor to allow some of the non-RSC eligible capacity in their BAA be eligible for export on their TSRs. So again, this is a totally optional constraint, and it's optional at the BAA level. The BAA can elect to enforce the constraint before day ahead, and then if it is enforced, they'll set the confidence factor and the reliability margin in each hour. And then their net exports on their transfers will be limited if the constraint is enforced. So we only saw CAISO use the EDAM net export constraint in May 2026. And based on discussions with stakeholders prior to EDAM go live, CAISO agreed to enforce the net export constraint for all days and to set a reliability margin in what were defined as stressed hours. Stressed hours are currently defined as hours ending 17 through 21. And so in this chart here, you can see we have non-zero reliability margin in those hours ending 17 to 21. And CAISO has decided to set the reliability margin to the most severe single contingency in those stressed hours, or as needed by operations. So we've only seen it set based on the most severe single contingency, and in hours, most hours across the month or most of the stressed hours across the month, that reliability margin was set to 1,500 megawatts for CAISO. And then there were certain hours in May, hours ending 19 through 21, where we would occasionally see some higher than 1,500 megawatt reliability margins. So again, the reliability margin makes the constraint more restrictive and decreases the amount of capacity within the BAA that's eligible for export on the transfers. This constraint was enforced on all days, like I mentioned, but we did not see it bind at all in May 2026. So we are enforcing the constraint. We are yet to see it bind. Let's go to the next slide.
Scott, we do have a hand raised if you want to take it now, or?
Sure, yeah. If you have questions on the EDAM net export constraint, let's take them now.
Yeah, so we have a hand raised from CD McLean. Go ahead, CD.
Thank you. Can you hear me?
Yep.
Excellent. Thanks for the rundown of that last set of statistics and measures. Wanted to suggest. Oh, I ought to have introduced myself. My apologies. Christopher McLean, staff with the California Energy Commission. So just one observation recommendation. So you indicated clearly that the MSSC was, only of a single variety. Sounded like there's maybe potentials for the ops team to sort of, observe a different, most severe single contingency, based on what's in or out of the network at the time, or have some other reason. So I would just advise that CAISO ought to be like as clear as possible for every sort of unique contingency that gets utilized here, and be prepared to classify those and track them over time.
Okay. Yeah, I appreciate the feedback. And we can definitely take that back. Yeah, thanks.
Thanks, and I'm not seeing any other questions this time.
Okay, great. So we'll move on to the RUC load adjustments. So as the title of this slide says, we did not see any RUC load adjustments in May 2026 for any BAA, but they are an option. RUC load adjustments are an optional adder that is added to the load forecast in RUC. And the goal of the RUC load adjustments is to allow operators to kind of add into the load forecast manually any things that may not be captured in the market. So additional concerns that operations might have, or the other piece, now that we are procuring the imbalance reserve product that can be met through a demand curve, the RUC load adjustment can also be set up to account for any uncleared imbalance reserve product in IFM and add the uncleared amount to the RUC load adjustment so that you make sure that you're clearing enough in RUC to cover your forecast and any uncertainty that was not met in IFM. So the CAISO has laid out the conditions in which we will use the RUC load adjustment under EDAM in the EDAM BPM. I think it's a good EDAM BPM section where it lays out very clearly what types of things we might use the kind of additional operator piece for, and then also how we will cover the uncleared imbalance reserve from IFM. But like I mentioned before, we didn't see any RUC load adjustments for CAISO nor PAC in May. Any questions on the RUC load adjustments?
I'm not seeing any questions coming in at this time.
All right, great. Well, thank you. We can go to the next slide, and I'll pass it off.
Yeah, thank you, Scott. Let's keep going with the topics of this call. We're now moving into some metrics that we are reporting as part of our standard reporting that we do for the performance of the market in regards to the settlements information. At the end of the day, it's a very critical piece of information to assess overall how the market is performing. Through the different discussions that we have had in previous calls, either in the implementation calls for EDAM, the market update calls, or the settlements user group calls, we have tried to provide the transparency of existing issues that we have identified, that we continue to investigate. And some of those issues have indeed impacted the first cycle of the T+9. All the metrics that are related to settlements for the sections of the report are based on the T+9 calculations. And I really want to emphasize the perspective that these numbers are very preliminary because they are going to change. They are subject to change in the next cycle, that is the T+70. Given the fact that we have identified already fixed several issues, these numbers are going to change. And please take all these metrics as preliminary, because once we have all these changes implemented, we are going to continue to report the updated, the revised metrics, and they are going to be different. The other factor is that even if there are no issues, there may have been some price corrections that we identify early in the process. And given the extended window that we have for price corrections to move from 3 business days to 10 business days, some of those corrections were not able to be on time to be reflected in the first cycle of the settlement. So there potentially could be a lot of changes once you go from the T+9 to the T+70. And all the metrics, again, reported in this first month of May are based on this preliminary information of the T+9. It is a balancing act of trying to give you transparency of how the market is performing, how these different key elements of the settlements are looking like, with the caveat that, well, they are going to be subject to revision once the next cycle comes. Next slide, please. Total wholesale cost. This is one of the more holistic metrics that we can have because it captures all the costs implied by operating the market. It includes energy, ancillary services, day ahead, real time, uplifts such as Bitcoin recovery, offsets, and now we have added the imbalance reserves and the reliability capacity cost. And here it's important to put in perspective the trend that we see. Every month is going to have different values because it's different levels of demand that we are clearing, different conditions of the system that may lead to different prices. So it is expected to be changing. And indeed, during the month of April and sometimes May, you could see that we go into this inflection point that we observe the lowest cost somewhere in April, and then we start going up as the demand increases and the price tends to go higher. So it is expected that the costs are going to be higher in May relative to April. That happened in 2025, that has happened in previous years, and that continues to happen for 2026. We can see that the overall cost for May are in the range of $19 average cost, and they are slightly higher than the wholesale cost of April. Next slide, please. BCR, this is another metric that is of interest to keep tracking all the time. We have here the breakdown by market, day ahead, IFM, and real time, also organized by the different balancing areas. We do see an increase of BCR in the day ahead market that goes from 1.6 million to 3.1 million. Part of that is because of the spikes that you see in the BCR that happen around May 19 and also on May 31st. We have indeed identified a couple of issues that we're going to be discussing later in the presentation that are going to influence the level of BCR that are collected for these days. So this number of $3.15 million is going to come down. We don't know exactly by how much, but it's going to be revised once we have the correction in place. For the real-time market, we see a trend that is not that different to what we have in May. Yes, we see some higher prices. And again, you can see that there are some spikes happening for May 1st and also May 29. These are also impacted by specific issues that we're going to discuss later on. So these numbers are going to also be changing once we have the revised calculation. Next slide, please. Related to the new products, we have imbalance reserve and capacity for both directions, up and down. Here you have a breakdown by balancing area on a daily basis that gives you the cost for the newly introduced market products. These numbers are also going to be subject to change. We have identified at least one issue impacting the imbalance reserve settlements for the upward direction that impacted one of the Pacific balancing areas. And here you have in the lower table the comparison for each of the products in the different directions, just to give you a perspective of the size of the cost for the market. For the imbalance reserve up in the CAISO area, that is the highest, is in the range of $1.7 million. Reliability capacity cost, that is more significant in the CAISO balancing area, reach the $4 million range. Next slide, please. Settlements. Now we have costs incurred in the day-ahead market because we have the product being cleared and procured economically based on the bid submitted by the market. When it comes to the real-time market, we have the two-step settlements that we clear or settle incrementally based on what the day-ahead market cleared. And here you have the daily trend. It is still in the low range relative to other market products that we have in the system. We see very few instances of buyback from the day ahead to the real time, as you can see in the lower portion of the trend. Overall, the costs are relatively modest for the provision of GHG in the day ahead market. Next slide, please. Congestion. This is another key area of the implementation of the extended day ahead market. We are showing different components in the report. This one is a very simple trend of the marginal congestion component effect on the different balancing areas. Yes, they are going to be diverging, and that is expected because congestion creates precisely that price separation, increasing prices in one area, decreasing prices in another area. And the average congestion price applicable to each of the balancing areas that you have in the day-ahead market are summarized in the top table. You are going to see that, generally speaking, the PAC East tends to track the pattern of the congestion from southern part of California balancing area, while PAC West tends to track the pattern of congestion in the northern part of the California balancing area. And that makes a lot of sense because that is how geographically, electrically, these areas are interconnected to the rest of the system. Magnitude-wise, you are going to see that the congestion component in the CAISO balancing area is significantly higher than the congestion component in the Pacific East and West areas. Next slide, please. Another feature that we have with the EDAM is that we are pricing congestion not only for energy, but also for the deployment scenarios that we call the IRD, IRU, because when we clear for imbalance reserves, we ensure that directionally, they are also able to flow through the transmission system when uncertainty happens and they have to be deployed. Overall, the congestion contribution from imbalance reserves is pretty minimal. There are very few constraints, and the cost overall for congestion on these constraints is pretty minimal. Still, energy, that is in this case labeled as base, is what makes most of the congestion effect for the EDAM so far in the month of May. The other dynamic that you can appreciate here is the relationship between the source of the congestion, where in the system the congestion is originated, versus where the congestion is reflected or priced. This is what we call the internal flows, when the source and the impact is in the same area, versus the source is in one area and the price impact is reflected in another area. Still, magnitude-wise, you are going to see that congestion originated from CAISO constraints is what drives most of the price congestion in the system. Very minor congestion observed or sourced in the PAC East area that has implications for either PAC East itself or CAISO area. There were no constraints creating congestion in the Pacific West area for the month of May. Next slide, please. Congestion-wise, we have another metric that is the congestion rents. This is the money collected because of congestion across the different balancing areas of the system. And there are different ways to measure this. We try to keep this metric as we typically have done for the CAISO, and that is, what is the congestion rent collected based where the congestion is originated? This is the metric that we have for the month of May, in which most of the congestion happened in the CAISO system to the order of $38 million. There were a couple of days where congestion was observed in the Pacific East area, and that accounted for about $1.7 million of congestion. Next slide, please. I have to caveat these metrics. There has been a lot of interest to understand what are the implications of the congestion revenue allocation methodology that was implemented with day one of the EDAM. I have to clearly indicate the metric that you have in this slide is not showing the congestion revenue allocation due to parallel flows alone. It is the combination of the congestion revenue allocation from parallel flows plus any internal congestion originated in PAC East or PAC West. It's all together. And this reflects the trend of congestion related to PAC East and PAC West for the month of May. Yes, there is a large spike in May 10th trend because that is the day when one constraint was binding in Pacific Corporation East. Overall, the dollar value for this is in under $1 million. For future versions of this report, we are going to explicitly break down the components of congestion sourced from internal PAC constraints and single out the portion that is specifically the congestion revenue allocation due to parallel flows. I have to caveat again, because when you see this metric as a whole, there could be some offsetting between positive and negative. It doesn't mean that the congestion revenue allocation component of parallel flows is going to be smaller in this case, because there could be some positives and negatives being offset. And that is going to be a metric that we will explicitly report in the future months. Next slide, please. Okay, let me pause before we move into the last component of the presentation regarding the market issues. Any questions, Cristina?
Thanks, Guillermo. Yes, we did receive a question in the chat from CD McLean asking, has the CAISO team begun to assess the upcoming changes implied by some of the PAC West asset sales?
Sorry, I couldn't appreciate the question. Let me see. Sorry, that is not a relevant question to this discussion. The question is if we are assessing the implications of Pacific West asset sales. Sorry, this is not a topic of relevance for this discussion, and we don't have anything to say about this.
Thank you. And other than that, I'm not seeing any other. Oh, we do have a hand raised now from Jordan Miner. Go ahead, Jordan.
Hey, Jordan Miner, CPUC Energy Vision again. Just asking about these price spikes we saw in RCD in May, and I think we saw a price spike for RCU in June, a big one. Is CAISO has done settlements on that, but those are subject to correction, as you were saying earlier. So is CAISO actually going to collect on those? I'm just trying to understand if ratepayers are on the hook for those price spikes or not.
Is your question whether these high prices for RC were valid or not?
Yeah, I think there's a couple days where it hit like 274 and 284. Yeah.
Yeah, these prices were deemed valid. I think we discussed the analysis that we performed on those in May. I understand there may be other high prices applicable for the month of June. We will cover those in the subsequent reporting.
Okay, thank you.
Thank you. And there's one more question in the chat. I sent it to you, Guillermo. It's from Hui Yuan asking, can you help us understand the impact of PAC parallel flows on CAISO transmission congestion and congestion pricing in EDAM?
Let me see, because that could be a whole elaboration. Can you help us understand the impact of PAC parallel flows on CAISO transmission congestion? Yeah, I'm afraid it's a whole discussion. We tried to provide that information in the report. I would suggest to please take a look at the detailed analysis that we put in the report. If there are additional metrics, similar to what we did for the pre-go live, happy to try to provide those. But I think I would start with the information that is contained in the report, and then we can elaborate more if there is something not covered yet.
Thank you, Guillermo. And I'm not seeing any other questions coming in at this time.
Okay, hi everyone, this is Jenya Raj. I wanted to go over some of the EDAM market issues that we're tracking and provide transparency on that. Some of these items have been discussed in the implementation calls, the May market update calls, and the settlement user groups. So the first one is that we have seen negative reliability capacity prices. This is due to several factors. We have a software defect related to MSG transition, but we also have market-driven conditions related to the optimality of the solution and then price formation once you add congestion and losses. So this issue is ongoing and we're monitoring it. The next one is invalid intertie constraint and intertie scheduling limit congestion shadow prices. So in early May, we saw that these constraints did not properly account for all the commodities, including energy, AS, and our new products, imbalance reserve and reliability capacity. We fixed that May 19th, and you saw price corrections for ITC and ISLs from May 1st through May 18th. Impacting our real-time market, we saw some negative flex ramp product prices. We were getting an incorrect requirement that led to those negative prices from May 1st through May 3rd. Those prices were corrected, and that was fixed May 4th going forward. Next slide. There was a GHG pricing issue early in May impacting the real-time market. So we had an inconsistency with the GHG area composition. the VA areas weren't accounting for the demand properly. We fixed this May 3rd and corrected real-time prices May 1st through May 2nd. We've seen an issue with infeasible solar RCU awards when a solar has also a PMIN re-rate and the VER forecast. There was an interaction there that was awarding RCU in non-solar hours. This is a software defect that we expect a patch for soon. The next issue in RUC, we have seen both RCU and RCD clear in the same hour on different resources when the prices are zero. And so, as we've discussed, RC is really a product for either over forecasting or under forecasting. Or so to have both in the same hour is it's not a software defect, but it's just a market issue that we're continuing to monitor. Next slide. Okay, one of the settlement market issues is that we're seeing high imbalance reserve settlement charges because we're missing data related to the non-compliance portion of imbalance reserve. So there's a software defect related to MSG resources. And so that was fixed May 20th going forward, and then you'll see the resettlement for May 1st and 19th on the T+70. Another issue is that we are missing shift factors in the market participant portal and the CRR system. So we are missing complete shift factor data to the market participant portal due to some payload issues. And then the CRR system is missing those shift factors related to the IRU and IRD deployment scenarios. We're working to get that software issue fixed. So that's still ongoing. An issue that was brought up earlier in this call is we do have a software defect where storage resources have been unable to provide reliability capacity down, even when they're economic and they have that sufficient state of headroom charge or state of charge headroom. So we're expecting that software defect to be fixed soon. Next slide. Another issue impacting that BCR settlement is that we are including the self-scheduled penalty price in BCR instead of just bid prices in the bid cost calculation. So this was fixed June 7th going forward, but you'll see the resettlement of May on the T+70. Okay, the next issue is there's flow discrepancies for intertie constraints in the CRR system. So when interties are mapped to multiple ITCs, the IFM flow calculation logic produces inaccurate results, leading to misallocation of CRR revenues. This one's ongoing, and we're seeking a fix for that. And like we mentioned earlier, there was high BCR due to negative bid processing. So this, you can see this particularly on May 31st. We were incorrectly processing negatively priced bids and setting those to zero. So that issue is ongoing. Hope to fix that with a configuration change in August. Next slide. Okay, that was the end of market issues. Do we have any questions related to those?
I'm not seeing any questions coming in at this moment.
Well, that's all what we have for this meeting, Christina. I would encourage participants to review the report that was posted yesterday concurrent with this presentation. That is to meet our commitment for transparency and timely dissemination of the performance of the extended day-ahead market. I would also encourage participants to submit any comments regarding the material that they have seen or any other areas of material that they would like to see for future versions. We have other areas that we discussed in the pilot operation process for the configurable parameters that now that we have settled with the basic methods, we are going to start developing and continue to assess how the configurable parameters are working. That is due to come in the future versions. And I think we have one more hand, Christina, before passing to you.
Yes. Yeah, thank you, Guillermo. Looks like we have a hand raised from Mike McGuffin. Go ahead, Mike.
Hi, Guillermo. Jenny, is there a will the ISO be correcting the errant BCR by the T70, or is that still TBD?
We'll have to report, we'll have to get together with our settlements group because I know they have, there's defects that impact the post-processing system, there's software defects on the market, and then there's their own configuration. So they're managing multiple things. So more details probably in the settlement user group for that one.
Okay, thank you. And then regarding the RCD defect, will the ISO, I mean, any idea when that will be resolved, and will you guys provide a market notice when it is resolved so we can begin targeting it again?
I know we're testing the patch right now in our testing systems, so hopefully it's going to come to production soon. I think we can find a way to communicate that maybe through our customer experience.
Okay, thank you.
Thank you. And I'm not seeing any other questions. Did anyone in the room there have any final thoughts before I move to close this call? All right. Thank you so much. As Guillermo mentioned, all presentation materials can be found at this link here. And I've also included that link in the chat as well. We're going to be posting a comment template document there as well. And you'll fill out the document and email it, the completed document, to ISO stakeholder affairs at kaiso.com. And those comments are due July 10th. And as Guillermo also mentioned, the next meeting date will be July 30th during the Market Performance and Planning Forum. I just have a couple announcements before we close out today. If you could go to the next slide, please. Here you can see some stakeholder meetings and comment submission deadlines occurring this week at the ISO. Next slide. Here's some DAME and EDAM resources. Next slide, please. Here's some information on market simulations and business practice manual updates. Next slide, please. For insights into the ISO grid market operations, be on the lookout for our Energy Matters blog or also our frequency band podcast as well. Next slide, please. Here's some details on the launch of a new publication series at the ISO. It offers insights into notable developments across the Western power markets. Next slide, please. And lastly, if you're interested in registering for the Stakeholder Symposium on October 5th and 6th, you can visit this link here. And there are also sponsorship of opportunities available as well. So with that, we thank you very much for joining today's meeting, and we hope you have a wonderful rest of your day.
All right, that concludes our conference. You may now disconnect.